Hello everybody, welcome back to Valuation Investing, and today in this video, this is part 2 of ranking the most popular stocks on my ranking system based off their valuations. And if you guys want to watch more of this series, hit the subscribe button and press the notifications because I'll probably be making more of these type of videos in the future. If we once again go ahead and take a quick overview of my ranking system, we can see that at a must buy, we would have an expected annual return of the stock of greater than 15%. And if it's undervalued, then I expect a return of 12 to 15%. Fair valued, I would expect about 8 to 12%, since that's about where the stock market normally average performance. Then overvalued, I have 5 to 8% expected annual return. And finally, for sell now, I have an expected return of less than 5% with my intrinsic value calculator. If we go over to my rankings, we can see the previous stocks I did last video. I'm going to put the link in the description, and also if you press it right up here somewhere, you can probably go see that video I made just a few days ago. And as we can see here, we have Google and Amazon in a must buy, Meta at undervalued, Visa, Microsoft, Nvidia, and Apple at fair valued. But today I'm going to be starting off with Broadcom. And Broadcom is the second largest semiconductor stock in the entire world, just behind Nvidia, and has seen huge gains from the recent AI boom. As we can see, over the past 5 years, it's up almost 753%. It has been outperforming the market by a huge margin. It has a market cap of almost $1.3 trillion. So this stock has really been moving up high. And they just recently actually acquired another company called VMware, which they are now a part of Broadcom. So they're broadening their company and diversifying their portfolio of companies by a lot. So this is looking good for Broadcom, especially with this past performance of 753%. I think it's one of the best ones we've looked at so far. But if we take a look at Broadcom's revenue, we can go right here. Once again, all these companies seem to have very good growth, and which is why these are such big companies, growing at such high margins at double digits and recently 50%. So right now they have revenue of $57 billion, and in 2010 they only had $1.5 billion in revenue. So just really good growth by Broadcom, which we like to see. Now for the earnings per share in the middle right here, we can see it has also been growing pretty good, but we've seen a huge pullback, which I'm pretty sure is from the VMware acquisition. So it's not too worrying, but I would say that you should probably make sure this isn't a long-term thing, but we can see it is rebounding in the past year, so it seems pretty good. But the thing I'm worried about Broadcom is, look at the PE ratio. It is at almost its all-time high if we don't factor in this fluke year, but it is basically at an all-time high PE ratio. Trading at 100 PE ratio is insanely high to me. This seems way too overvalued just based on the PE ratio, but if we go ahead and take a look at what they're expected to make in the next 5 years, analysts expect them to grow at about 25.7% rate year over year. So this company is expected to grow very fast, probably from the AI, which is probably because of the huge AI boom and all the demand for these chips. So they're expected to grow at a very fast rate. So this looks good for Broadcom. So if we take a look at Broadcom, we're going to use my intrinsic value calculator to determine what price I'd be willing to pay for Broadcom stock. So for the revenue growth rate, we can see they've averaged about 20% revenue growth rate. Analysts expect them to grow at about 27%. So I'm thinking a pretty fair revenue growth rate for Broadcom's 15%. Because I do think that they're going to start to decline a little bit more. Because it's such a large company, I don't think it can sustain this much growth. But I think 15% is reasonable. Now for the net profit margin, we can see in the past year it was at 23%. In 2024 is actually at 11%. But I do think that's just a fluke. And I think around 25 to 30% net profit margin is fair. And I'm going to put a 30% net profit margin. Now for the terminal PE ratio, we can see it's been trading at such a high PE ratio, which I think is too crazy. I think that a terminal PE ratio that's fair for Broadcom is 25. I don't think this is a huge moat company, but I do think that they deserve this premium. So 25 PE ratio, a bit higher than the stock market, so I think they deserve it with that growth rate. Now for the discount rate, we're going to put at 10% to see the fair value price. And I get a fair value price for Broadcom at $183.85. So with this being said, I get a forecasted return of 5.5% annualized return. While these assumptions may be wrong, I think this is the most likely assumption, and I want to be slightly conservative just in case it's a little bit off. So we could definitely see better returns. With this being said, I think we're going to put Broadcom in the overvalued category for now. They are pretty close to a sell now, but I do think that this is such a good quality company. I would definitely not sell it if you actually have shares at a decent price. I'll definitely hold these shares, but I don't think we should be buying into this stock right now just because of how overvalued I believe it is. It's only been making $50 billion in revenue and not a lot of earnings, and they're trading at a $1.4 trillion market cap. I just think it's a little too overvalued for Broadcom. The next company that I'm going to be looking at is Oracle. And Oracle has seen huge gains over the past year or so as a result of their AI guidance and just good earnings report. As we can see, year to date up 26%, and they just recently had earnings on June, I think 11th. They had pretty good earnings and have shown that it better than expected. So this is why the stock is up a good amount year to date, and in the past 5 years up about 275%. So Oracle's been doing a pretty good job in that space. However, if we take a look at Oracle's revenue, it doesn't look amazing. While it's not bad, it just doesn't look insanely good compared to some of these other companies. The thing I like is that since 2022, we've seen a lot more growth in this company, but not even really double-digit growth. It's high single-digit growth. So it's not fast growing, and as we can see from 2012 to 2020, it was basically stagnant. So compared to these other companies that I've analyzed so far, this company is slower growing, but it's not necessarily a bad thing, especially if you get it at a good price. So not necessarily bad. But if we take a look at their PE ratio, we can see it's at a 48 PE ratio, which is higher than Microsoft, Apple, Google, Amazon, Nvidia. Is basically higher than almost every company I've analyzed so far. And as we can see, it was trading at about a 15 to 20 PE ratio since before 2020, but since 2020 we've seen a huge overvaluation in the stock, and the earnings per share isn't really growing that fast. So this doesn't look very good for Oracle right now just because of not very fast growth, but multiple expansion from the PE ratio just has me worried that I don't think this is a good value right now. But if we take a look at analyst expectations, they expect Oracle to grow at about a 12.5% rate in the next 5 years. So once again, pretty good expected growth from most of these companies at over double digits. So this looks pretty decent for Oracle, but over the past 5 years, as we can see, is very slow growth, 4%. But since in the next 5 years, analysts expect 12.5%, probably from AI and the huge demand for Oracle, I do think that this could be reasonable. But if we go to the intrinsic value calculator for Oracle, since they're expected to grow at about a 12% rate, that is for the earnings per share, and I don't think the revenue growth can grow that fast. We can see it's averaged about 8%, so I think a fair place for the revenue growth rate for Oracle is 8%. Now for the net profit margin, we've seen it's been pretty consistent, anywhere from 20 to 22%, and I'm thinking a 22% is pretty fair for Oracle. Now for the terminal PE ratio, I think the terminal PE ratio for Oracle is, I think, good at 23. I think 23 is pretty fair for the stock just because it's pretty much an average growing company, and it is slightly above average of some other companies in the S&P, but it's definitely not top tier. So I think 23 is a fair value for Oracle. And with this, I get a fair value price for Oracle at $124 per share. And I get an average forecasted annual return for Oracle at only 3.5%. So if you bought this today with these assumptions, if they do play out, I think you'll only make 3.5%. So with that being said, Oracle is the first stock to go into the sell sell now category. But would I say if you own this stock to sell it? I probably wouldn't say you should sell it. You should probably do your own research and see if you think it's actually wrong, my assumptions. But with my assumptions, I believe you should probably sell now, or just at least do more research on the stock if you already hold it. But I definitely don't recommend buying this stock just because it looks way too overvalued with slower growth. The next company that I'm going to be looking at is United Healthcare. And as we can see in UNH stock, we can see over the past year to date, it is down almost 40%. After huge news that they're being investigated for fraud on Medicare and also terrible earnings, and just after the CEO got assassinated, it's just been going downhill from there. After huge CEO changes and just the company overall not doing great, especially with their guidance. But over the past 5 years, it's basically flat. So United Health stock, if you bought this 5 years ago, you aren't really happy right now. But this could be a perfect time to buy if we take a further look into the company. And as we can see with their revenue growth, it's been very consistent at about 10%. It's very consistently growing at a fast rate, going from almost $88 billion to $410 billion in the healthcare sector, in which they are basically an insurance company. Not just an insurance company, but that is their main way of making money. But if we take a look at their earnings per share and also their PE ratio, we can see their earnings per share is also following suit. But since 2023, they had a huge drop in earnings per share and then another rebound right there. And right now they're trading at a very low PE ratio of 12.93. And the last time they traded at this area was in 2014. So over 10 years ago, this was where they were trading at. So right now, on the PE ratio standpoint, it looks very good. But the future, we don't really know about United Health because of all the problems that they are having. But I would say if they are able to turn this around, this could be a perfect time to buy. And analysts actually expect them to grow at about a 9.5% rate with their earnings per share. So United Health looks pretty decent right here at that rate. Now for the intrinsic value calculator. Analysts expected them to grow at about 9.5%. I do think that health insurance companies are going to slow down just a little bit. And I also do believe that the revenue growth rate if we see here on the average in the past, they've grown at about 12 to 10%. So since analysts expect about 9.5%, I'm thinking a 7% revenue growth rate is pretty fair for United Health. Now for the net profit margin, we can see it's been basically at 5% over time, and I think that's pretty much where it's going to stay. Now for the PE ratio, I believe that they do not deserve a huge PE ratio. However, I'm not going to say they deserve a tiny one either. I think an 18 PE ratio is pretty fair for United Health. And with a discount rate of 10%, I get a fair value price of United Health at $493 per share. And I think if you bought this today, you can make about a 16.7% return on your investment. However, I would like to say I have been really interested in this company. However, I have not yet bought in just because of the huge uncertainty of the future for this company and all the lawsuits that are against the company. I would be very, very conservative on these assumptions and just do more research and potentially wait it out just a little bit to buy, because there's just too much uncertainty, and the stock market likes to have predictability, and that's probably why the stock is down so much. But once again, if you do believe these assumptions could be true, I do think that you can make a pretty good return on United Health. So with that being said, United Health is actually going into the must-buy category. But once again, I would do a lot more research and make sure that you are buying a company that you know. And there is a lot of uncertainty, like I said, with this company and all the lawsuits that is going against them. So that is a big worry for me. And I have not personally bought yet, so I would be careful about that. The next company that I'm going to be looking at is Tesla. And if we look at their stock, we can see that they've actually been down almost 15% year to date. And they actually just released more news about their robo-taxi, and we were pretty hype about that. However, we have since seen that not really good progress in the robo-taxi, especially compared to Waymo, which Google owns a part ownership in. Robo-taxi for Tesla seems a bit behind when compared to Waymo, and that's probably why Tesla's down. And also they saw that in China their revenue has decreased a good amount. So far Tesla isn't looking too good year to date. And if we take a look at the revenue, we can see insane revenue growth from basically 2010 all the way to 2023. However, since 2023, it's actually just stayed right at $95 billion. So this is pretty interesting to me, and I would keep an eye out on this because we don't want to see stagnant revenue growth. We want to see this increasing over time, and I would be slightly worried about this. However, I wouldn't be insanely worried since it's only been over the past year and a half or two that their revenue's been staying the same. So it's not a huge worry, but we need to make sure it doesn't happen more in the future. And now if we take a look at their earnings per share and PE ratio, we can see that their earnings per share was doing very good until 2024. Since 2024, we've seen a huge decrease in their earnings per share, which is not good for the stock. And also trading at 185 PE ratio, which means that you're paying $184 for $1 of earnings from Tesla. So you are paying a very high valuation, and the stock market runs on average a 20 to 25 PE ratio. So you're paying about 7 times the stock market average. So hopefully you're going to see a huge earnings per share growth rate, or else it's probably not worth it. And as we can see, analysts do expect Tesla to grow at about a 19% rate in the next 5 years annually. So this looks pretty decent for Tesla. However, I would say that for the PE ratio, this looks a little bit lower than I would want. And especially for most of these other companies, seeing that like Nvidia is going to grow at over 25%, Broadcom 25%, and they've had less than half of the PE ratio of Tesla. So this worries me a little bit with Tesla. But if we go ahead and look at the intrinsic value calculator, I'm going to put a revenue growth rate, I would say, of 15%. Since analysts expect them to grow at about 19%, I think 15% could be a fair revenue growth rate in the next 10 years for Tesla. This is a little bit more bullish, but I do think that they can grow at about 15. Now for the net profit margin, we can see that they're about 15% net profit margin, but in the last year they've decreased to 7%. So I think that they can get back up to about, I think that they can actually get to 17% if I'm a little more bullish. Just because I do think that they're going to start to scale their business and go into other fields, and I think that they can actually bring that net profit margin up a little bit higher. Now for the terminal PE ratio, I think a fair terminal PE ratio for Tesla is 25. Just because of the revenue growth rate only at 15%, I think that's pretty fair for Tesla. With that being said, I get a fair value price of $239 per share, and if you bought this today, I think you'd make only about 6.5% annual return. So I do think Tesla is overvalued, and this is the second stock I'm going to be putting in the overvalued category. The next company that I'm going to be looking at is Adobe, and Adobe's stock over the past year has seen a pretty bad decline in the stock, down about 31% over the past year. We can see that Adobe has not been having a good time, probably because of the worry that AI is going to take over their business. However, Adobe in their recent earnings has been doing pretty good, and also the CEO has been saying that they don't really think AI will take over Adobe, and they're also trying to transform their business into a more AI focused company. But once again, the CEO did say that they think that humans are going to want more of a human sort of control over, like, say, Photoshop and editing. So they believe that AI isn't really going to affect the business that much. But however, Wall Street does show that it probably will in the future, but nobody really knows. So, but if we take a look at the revenue growth rate for Adobe, once again, very good revenue growth rate at about 10%. And it's been increasing basically over every year. And as we can see in 2015, this is about when they had their subscription-based model put into place where you just have to pay monthly. So this is why they have pretty good recurring revenue, and I like that about Adobe. And if we take a look at Adobe's EPS, we can see it's also been growing at a pretty good rate. Well, although it was stagnant from 2021 to about 2023, we're starting to see that growth come back again. And also the PE ratio is at a pretty low point for Adobe at about 24 PE ratio. That's pretty low for this company, and it hasn't been there since 2012. So right now it seems pretty good on a PE ratio valuation standpoint. And also if we take a look at Adobe's expected earnings per share growth rate, analysts expect them to still grow at about a 12.5% rate, so this looks still pretty good for Adobe. However, I would say be careful about this company since we don't really know about Adobe in the future with how AI could potentially make this company go pretty much nowhere, or it could make the company just crumble. So we don't know what AI will do to this company, so I would say be careful with that. However, on the financial statements, this company looks pretty good, so this is still pretty interesting to me. But now for the Adobe assumptions for the intrinsic value calculator, I think Adobe will grow their revenue. I think 8% is pretty fair. While analysts expect them to grow it at a pretty good rate, I do think 8 to 10% with their revenue growth is in a fair spot. Now for the net profit margin, I think a fair net profit margin is actually 28%. Since it's been anywhere from 25 to 35%, I think 28 is pretty fair for Adobe. Now for the PE ratio, I'm going to put in a 23 PE ratio for Adobe. And with that being said, I think Adobe's trading about at its fair value price, which I have a fair value price at $412 per share. I think if you bought this today, you'd make about a 10.9% return on your investment. So if we go and take a look at our rankings, we're going to put Adobe right at fair valued with most of these other companies, which makes sense. The next company I'm going to be looking at is Nike. And Nike in the past day has actually seen a very good return, up 15% after releasing a pretty decent upbeat earnings, where they have beat expectations and have shown that maybe they are in for a revival of the stock. However, over the past year, it's still down 6.2%. In the past 5 years, you're down about 27%. So Nike stock has been getting obliterated over the past 5 years. But just in the past day, it's up 15% because of that decent earnings report that was better than what analysts expected. Now for Nike's revenue, we can see that they were increasing their revenue at a very good rate all the way until 2023. We've seen a decline in their revenue by about 10 to 7%. So this isn't looking very good for Nike, but if they can return back to the previous revenue, I think this could be a pretty good spot to buy Nike. But once again, I think people are worried that Nike is going out of style just a little bit and that their moat isn't as big as what people expected, because I personally don't believe that big brands is necessarily a good moat. But I do think that other competitors are getting in the space and they don't really have a huge competitive advantage over other companies, but they still do have probably the best competitive advantage. And if we also take a look at their PE ratio and earnings per share, we can see it's increased over time at a decent rate. But since 2021 or 2022, we've seen that they've been slowly decreasing in earnings per share over time. And they're trading at a pretty low PE ratio, actually. Since 2017 was the last time they were at this PE ratio of about 23. So right now, the earnings per share is declining, which is not very good. And also with trading at a 24 PE ratio, you'd be expecting at least their earnings to be growing over time. But right now we can see it's actually been decreasing over the past 2 to 3 years. So far not looking amazing for Nike. However, this could be a good place to buy, especially if they're able to revive the business. And if we take a look at analyst expectations, they're expected to grow at about a 15% rate, which I think is a lot higher than what will actually happen, me personally. But I don't know, I'm not an analyst, but I think that's just absurd. I think that's way too high, but who knows? Maybe they can achieve that, and if they do, I think this is a perfect time to buy if that is true. But if we go over to the assumptions, look at the revenue growth rate. The reason I don't think that they're going to grow that fast is because I don't know where they're going to be growing that much. They have to make up for it somehow, whether they're going to increase their profit margins by a huge margin or their revenue growth rate just goes insane, which I highly doubt. But with the revenue growth rate, I'm thinking about a 5 to 7% revenue growth rate is pretty fair. They've been on average anywhere from 5 to 6%, so I'm thinking a 5% revenue growth rate for Nike is fair. Now for the net profit margin, I'm going to put this right at 10%. Since that's about the normal average for Nike, I think that they can stay around that area. Now for the terminal PE ratio, I'm going to put a PE ratio of 20. I don't think that Nike is a very good company right now, and we need to have them prove to us that they are worth a higher valuation. And with that being said, I get a fair value price of $65 per share, and I think if you bought this today, you can make about an 8.7% return. Once again, we have another company, Nike, going into the fair valued category. So we already have 6 companies in the fair valued category, which makes sense that they are trading at their fair value. Now for the second to last stock, I'm going to be analyzing Palantir. And Palantir stock has been going insane over the past year. We can see it's up 405% just in 1 year. So this is just insane returns and looks pretty good for the stock. The past 5 years up 1,300%. Just insane growth from this company, and is at a market cap of almost $310 billion. So this company has been going pretty crazy. And Palantir has been seeing positive effects from AI and also being given government contracts. So this looks like a pretty good company. However, I do think this is probably overvalued right now. But if we look at the revenue growth rate, it's been growing at a very good rate, anywhere from 20 to 50%. So this is still really good growth rate. Now taking a look at the earnings per share and PE ratio of Palantir, we can see that they were a previously unprofitable company until 2023. They started to make some money here. So at least they turned profitable. However, I would like to add, look at this PE ratio. 568 PE ratio is just insane. That means you're paying $568 for $1 of Palantir's earnings. So you are paying so much more than the average that the stock market trade at. But I would say they definitely do deserve the premium just because they are a fast growing company. But this premium just seems way too much to me. But if we take a look at Palantir analyst expectations, they're expected to grow at 32% over the next 5 years. So this is still pretty fast growth from the company. And now if we go ahead and look at our intrinsic value calculator, we can go ahead and put a revenue growth rate. I think a fair revenue growth rate for Palantir is 20%. They've been averaging about anywhere from 20 to 35%, and I do think it's going to slow down just a little bit, but I do think 20% revenue growth rate for Palantir is pretty fair. I think that's a good place to be. Now for the net profit margin, we can see in the past year they were at 18%. I think that they're going to continue to increase this net profit margin by a good margin. However, this is basically a guess of what I think that their net profit margin will be. I'm going to put a net profit margin of 30%. I think that they can somehow get up to there. Now for the cash conversion rate, we can leave there. For the PE ratio, I'm actually going to give them a 30 PE ratio. Just because of the huge growth out of the company, I think that they deserve this PE ratio. However, with these assumptions, I get a fair value price for Palantir at $32. But if we also, maybe they grow at say 30% revenue growth, and if that's even the case, I think that you're going to make only 3%. So nonetheless, I think this company is a sell now right now. While I do think this company is a very high value company in terms of, I think that they could grow in the future and they're just a good company overall, I think they need to get their financials in a little better position, and also just the valuation's way too high for me to be buying today. So with that being said, I'm put Palantir in the sell now category. So we have 2 in the sell now category with Oracle and Palantir. Now the final company that I'm going to be looking at is Uber, and Uber has actually had a huge buyer come in and invest in the company, which is Bill Ackman. He has made a $2.2 billion bet on the company, so this is pretty good looking for Uber just because we have a very good investor, super investor, that has just recently invested in the company. However, being that said, we should not invest just because someone else did. We need to do our own research. But if we take a look at Uber stock, over the past 5 years, it's returned almost 200%. So pretty good performing stock as we can see. But in 2022, it was at a pretty low valuation. So that looks pretty good. But right now, we're at all-time highs on Uber. So it looks pretty interesting, especially that Bill Ackman just recently purchased this company at such a high valuation. But while I do say high valuation, I am saying a high price at all-time highs. But right now, I'm pretty sure Uber is trading at a very low valuation. And if we take a look at the revenue growth rate, it's just been increasing at a pretty good rate, anywhere from 15 to 20%. It looks pretty good for Uber at a pretty decent pace. But like I was saying earlier, with saying that we're trading at a very high valuation, in reality, even though the price is very high, our valuation isn't that high. Right now, they're trading at a P/E ratio of 16. When compared to the stock market trading at 25 P/E ratio, with this being said, it's trading at a lower valuation than the stock market, even though their earnings growth rate has been very fast. So right now, the valuation looks pretty good, growing at about, I don't know, it's growing at a good rate. I don't know the exact rate, but we went from negative profitability to very profitable just in the past few years. So for Uber, it's looking good right there for the valuation and earnings. And over the next 5 years, they're expected to grow at a 27% rate for Uber. So this looks like a very interesting company, and I can see why Bill Ackman has bought it. And I'm looking very closely into this company because I think this is a pretty good company, especially after they turn profitable. It's very interesting. Now for the intrinsic value calculator on Uber. Over the past few years, they've been revenue growth rate anywhere from 15 to 20%. So I'm thinking a revenue growth rate of about 15, actually let's go 13% to be a little safe. Just because they have a little bit of worry over how their employees are stated, whether they're individual contractors or employees. If in the future they actually are called employees, then that means they're just going to have huge problems with having to pay them much more money. So we could see some problems in the future with the law with Uber, but I think 13% is pretty reasonable. For the net profit margin, I'm actually going to put this at 20%. Even though in the past year they were at a 27% net profit margin, I do think that that's a little too high, and I don't think that they can sustain that profit margin. Now for the P/E ratio, I'm going to put a P/E ratio of 20 just because I think Uber does have a little bit of worry in the future with the law, and if certain states will sue them or cities, we can see some problems there with Uber. But I do think that they're diversifying enough, and I think they deserve a 20 P/E ratio. With that being said, I get a fair value of $161 per share and a forecasted return of 17.7% with Uber. So this looks very good right now for Uber, and I think this is the biggest return out of any company we've had so far, I think, with these assumptions. Although don't necessarily buy this company just because of this video, do your own research, but with these assumptions, I think Uber's a very interesting stock to buy, and I might be buying this company soon if we see a little dip. I'm very interested in buying this company. So with the final company, we have Uber going into the must buy. As you can see, we have 4 companies that must buys: Google, Amazon, United Health, and Uber. Then we have one undervalued stock at Meta. Then we have Visa, Microsoft, Nvidia, Apple, Adobe, and Nike in the fair valued. And overvalued, we have Broadcom and Tesla. And then 2 in the sell now of Oracle and Palantir. So if you guys want to watch the video from the other day on the first 7 stocks, which was the big tech, the biggest companies basically in the world, I made a video. Please press the link in the description. And thank you guys for watching this video. Please like, subscribe, and see you later.